Hello, everyone. So excited for today's session. We're going to give folks a second just to get in the room. Seems like a lot of you are starting to join us. So we're super excited to kick off. We have an awesome guest with us today. So if you are in the room already, if you can just drop us a note, let us know where you're joining us from, maybe like a fun fact about yourself. And then we're going to kick off here in just a second. Right. Let's see where everybody's joining us from. Perfect. Well, for those who don't know, I have with me our very esteemed guest. This is Max Pashman. I call him Money Max. I don't know if other people call you Money Max or if I made that up, but I feel like you are the premier resource for all things money, especially for sellers and folks that are in our field. So I'm super excited to have you on today. But before we kick off, just wanted to kind of set the stage here. This event is hosted by Women in Sales. That is the community that so many of you are part of. We are really focused as an organization on helping women find success in the field of sales. And ultimately, not only do we want to attract women to choose a career in sales, but we also want to make sure that folks are getting promoted and continuing to see success long term. So a lot of the content, events, resources that we have and that we circulate are all focused on making us the best salespeople that we can be. And we have members now all the way from folks who are even considering a career in sales all the way up to C-suite. So we're really focused on having this inclusive community where everybody has a seat at the table. So again, we wanted to just quickly thank some of the organizations that are directly investing in women in sales and continuing to help be a catalyst for our continued growth. So those organizations that we do partner with today are AirMeet, Aligned, Aspireship, Chili Piper, ComSoar, Demand-Based, Motive, Lavender, QuotaPath, Vidyard, Unifor. So I almost have it down. All right. So thank you all so much for being great supporters of Women in Sales. So Max, a lot of folks I'm sure I'm connected to, but my name is Alexine Boudoir. I'm CEO of Women in Sales. I'm really here to learn alongside everybody else at this event. So I'm just kind of kicking off here and I'll be monitoring the Q&A. And yes, this session will be recorded and it will be available through our events portal on our Women in Sales website, which is www.women-in-sales.com. So I'll drop that in the chat too. But Max, tell us who you are, tell us what you focus on, and let's start the conversation there today.
Yeah, absolutely. I appreciate you having me on, Alexine. So my name is Max Pashman. I run Pashman Financial, a fee-only financial planning firm based out here in Los Angeles. And my firm is very focused on helping sales professionals, tech professionals, and formal sales professionals that are turned to solopreneurs, helping them with their financial situation, really giving them clarity on their paycheck that they are receiving and some direction as far as what they want to do. And my goal has been really to give people a sense of confidence over their finances, especially in complicated topics like we're about to dive into today with equity compensation, but delivering it in a way that they can simply understand. So my goal has been able to help people visually understand their finances and giving them the enthusiasm that they need to make sure that they're continuing on their plan. So that's a little bit about myself. And I'm really excited to go over this particular topic because it's one that has been brought up a lot by sales professionals. And there's a lot of areas that we could be covering in this, but I think that what's important is really just going over the basics. We can get as complicated as we want, but I think it's important for people to have some clarity over their situation. So how should we kick this off? Should I just go right into, what I have here, or how you want to start this?
Yeah, so a couple of things to note here. So one thing we wanted to preface this entire session with is that this is really an open forum. During the session today, we're going to go through questions. We're really going to start at a very kind of high level with some of the terminology and vocabulary that's going to be used. We want this to be a very low ego conversation here today. So definitely encourage you all to post your questions, continue to send those throughout this conversation today, and I'll start to sprinkle those in and make sure Max sees those. But again, want everybody to just kind of set the stage with feeling comfortable asking any questions. This is a judgment-free zone, and this is an area, stock options and equity, that we should be more well-versed in. So So yeah, I'd say let's start on kind of like that high level, the vocab, kind of take us through some of the words that get thrown around regularly that maybe we even use that we don't totally know what they mean.
Yeah, so I think the first thing to go over is kind of the importance of equity as it is. Like, why is it something that we should be covering? Why it's something we should be talking about? Well, the reason why companies even issue equity in the first place is that when they're in that startup phase, they're given a limited amount of cash from their investors, VCs, and whatnot. So they want to make sure that they're reinvesting as much of that cash as much as possible. But of course, there's a limited amount. They need to retain employees and they need to make sure that they're maximizing as much as they can. So, what companies do is they offer this equity as a way to supplement some of that compensation that they provide. So, it helps companies in that sense that they are allowing another way of compensating their employees. But this also leads to something else, which is really incentives. Because of how these equity structures are created, it incentivizes people to stay with the company for a long time. And they're commonly known as golden handcuffs for this reason. So there's a reason for employers to actually give this to employees, and there's an incentive for employees to stick with the companies. But it doesn't have to feel like a trap either. There's a lot of opportunity inside of it. You could be someone off the street and you could be in this company and be given private equity that would be exclusively for accredited investors, angel investors, VCs. This is private equity that's being given to you. And you could have this equity that could 10x, 100x, or 1000x, depending on what the size of the company. So it's a great opportunity to take advantage of. But of course, equity itself, especially pre-IPO, is high risk as it is. There's a likeliness that the company could fail compared to a publicly traded company or anyone at the top. So it's important to assess that while it's great to have this opportunity, there's a lot of risk associated with it. And then some of the things also worth noting is that there are also tax benefits that come from it. And we can get into that complicated session later. But I think some of the more important ones to go over, there's four terms that I usually like to go over are the grant, exercise, strike price, investing schedule. So what are all these different terms? You're going to see grant all the time on your terms and conditions if you have your equity with Carta, you'll see it all the time. The grant date is the date that your actual contract actually goes into effect. And that's important because it tells you the time frame in which you could actually be given your stock. And depending on what your schedule looks like, they could be in different dates. So when you see grant date, that means this is the date that your equity actually goes into effect. As far as stock options are concerned, the most common one that you're going to see is an exercise. And what this exercise basically means is it gives you the right, but not the obligation to actually purchase that stock for yourself. And the reason why that's important is because exercising it gives you not only the option, but it could potentially give you a deep discount at purchasing stock itself. And the third terminology is the strike price. That's going to be the price that you actually exercise your stock at. And the last one that you're going to see is a vesting schedule. What a vesting schedule is basically the time frame in which you can receive your stock or simply have the option to exercise them. Again, this kind of goes back to the golden handcuffs phrase that I gave earlier, which is it's the time frame in which you can be getting it over time, but not immediately. So these specific terms are really important to take note of because when you sign off with a new employer, you're going to see those terms thrown into there, and really harnessing on those four is really important, I think.
Amazing. While you are covering kind of like our key terminology that this conversation today is going to sort of centralize around, we ran a quick survey, a quick poll here rather, just to understand what level of familiarity everybody that's here today has with this world. And so it looks like the vast majority of the folks who voted have some familiarity, with the second highest group having no familiarity whatsoever. I feel like that's very much a common experience. I don't know about you, Max, but this wasn't like necessarily something that was covered in school. It wasn't something like that we had like classes on. So I feel like I don't even really know where I learned about a lot of this. I think it was more so on the go or like as I was navigating or messing up a job offer. So I knew to do it a different way the next company. But it is interesting to see that across the board, it seems that there's still kind of a lack of familiarization with this world. And this is a really critical part of how we all are getting paid. And so just an interesting poll for us to run here today to set the stage a little bit too.
Yeah, I mean, I think the fact of the matter is when it comes to personal finance, there was a lot of things that we weren't taught in school, and this is definitely near the bottom as far as understanding it. And it's, I mean, even when I was learning about it, it was really difficult to grasp at first. So you can imagine how difficult it is for someone that isn't familiar with finances or isn't even good with money whatsoever. So
Mhm.
what I have done here is I have a couple of visuals I can show in the presentation that I have here that can help kind of understand some of these terms that I threw out there. And I think it would really be helpful to just see what that actually looks like. So I'm going to present this really quickly into there's a lot of different sections that I could go over, but I think what's really important is to go over um, some of the areas that I just clarified here. So I talked about this section over here, kind of the benefits of why you should be going into equity. Again, it's an alternative to cash. You get access to growth. There's high risk associated with it, and there are some tax benefits that are associated with it as well. And I think that with the taxation part, I want to go over that part very quickly here. And the taxation part that you're going to commonly see is a term called long-term capital gains. You're going to see this come up all the time when you own equity itself. When you receive income from your employer, it's taxed as W-2. So when you receive income, it's going to be taxed at different levels between 10%, 12%, 22, 24, 32, or 37%. It ranges all over the place when it comes to that. And depending on where your income level is, it's going to determine how your income is going to be taxed. With long-term capital rates, it gives you a pretty preferential way of getting taxed on your capital that you have. And to clarify what this applies to, when we say capital, it could be anything from stocks, real estate, business, even crypto would be into this. It's any assets that you physically own that appreciate in value over time. And the rule is very simple with long-term capital gains. If you have held this equity for more than 1 year, you are eligible to be in these rates. If you hold it for less than 1 year, it's going to be taxed as income. If you are eligible for it, there are 3 brackets: 0%, 15%, 20%. And that can make a huge difference, especially if you make high income or expecting a higher bracket. But I wanted to emphasize this particular point because I will be mentioning capital gains a couple of times. And it will be important to assess that as you go through these appreciation levels. These were some of the terms that I had mentioned earlier, from the grant date, the exercise date, the strike price, and the vesting schedule. And I think what's very important to understand with these are the types of equity that are going to be delivered to you. There's 7 different types of equity plans that you could be accustomed to, but there's generally about 4 of them that you're most likely going to see as an employee: RSUs, NSOs, ISOs, and ESPPs. So I'm going to, in terms of like diving into some of them, I think it's really those 4 that I'm going to be going over in this. But what I think is important, first things first, is to have a distinction between restricted stock and stock options. These two get confused with each other, so I think it's important to break this down. When you have restricted stock, this is, option or sorry, this is equity that's going to be typically in earlier stages or even publicly traded, but it's reserved within the company. And the biggest thing that you need to know about restricted stock is that it is given to you outright when you are eligible to receive it. In other words, you don't actually have to pay anything to get restricted stock. The company just gives this to you. So as a result of that, it's taxed at such. We don't have to get too much in the details of what that actually looks like dollar for dollar, but it's treated as though you are receiving your own compensation. And I'll show a visual of what that actually looks like. But for restricted stock, that means that an employer or whoever, whenever you are eligible for that compensation, it's given to you. Stock options, on the other hand, requires a commitment, meaning that you actually have to pay for the stock options out of pocket, or exercising it, as we like to call it. That's the biggest difference between these two. So I think that when we talk about exercising, when we talk about vesting, it's important to note that exercising is strictly tied to stock options, not restricted stock units. So I do have a couple of illustrations to show on this. So the first thing I wanted to show is the vesting schedule. So you'll see this come up all the time. And basically what vesting means is, when can I actually receive my equity inside of the company? And the most common one that I usually see with equity plans is a 4-year vesting with a 1-year cliff. The heck does that mean, right? What it basically does is it shows in this visual that I put here what that actually means. If you start at year 0, this is your hiring date, or this is the date that you are actually granted this stock. So in year 0, you don't receive any stock at first. You have to wait till 1 year goes by. So if this person, for example, had this schedule and they had 1,000 shares, in year 1, they would receive 250 of those shares immediately. So they would be entitled to receive those right at the spot. And then as time progresses, they get a little more stock along the way. By year 2, they'll have 500. By year 3, they'll have 750. And by year 4, they'll have 1,000. They'll be fully vested by then. So when we say vesting, it means the time frame in which you can actually receive them. Now, going back to when I was mentioning between restricted stock and stock options, I really want to emphasize this point, that restricted stock, when the stock vests, that means the company gives it to you. So in year 1, when 250 kicks in, that means I immediately receive the 250. Stock options, on the other hand, when the 250 is there, that means I have 250 that I can actually buy on the spot. It doesn't mean that you have to. It just means it's the ability to actually buy. So it's really important to assess that in here, because I think that a lot of people get confused. And when it comes to restricted stock, there can be some immediate tax consequences that come from it. So I'll kind of leave it there for now.
Yeah, Max, there's an example I want to bring up, so don't let me forget to circle back to that. But this is a really critical, so I'm sure some of you have heard of vesting schedules. Why this is so critical, and this is something I misunderstood really early on in my sales career, is when you're looking at an offer and you're weighing kind of like, what's my OTE? And do I want to do a trade-off maybe on, do I want to lower OTE in exchange for, more option? Like, you're kind of trying to figure out what that offer package is going to look like. This is incredibly critical, because there is a misconception that if it says I'm going to have 1,000 shares, it's like, okay, I walk in the door, that's mine. I take it and I go. But the problem is, if you don't look at this vesting schedule, then all of a sudden, if you leave after a year, that really didn't have like a huge impact on anything. And so you may have potentially traded off OTE. So for me personally, I think I've talked to you about this, Max, but I spent 10 years in enterprise sales, building enterprise for early stage startups. For me, this was actually like a piece that I did prioritize, but I prioritized my OTE more, because I was like, the likelihood that I'm going to stay with these companies more than 3 years is very low. And knowing that some of them may go under, knowing that it's very tumultuous, knowing that a lot of them are early stage. So these are very real considerations to make as you're thinking about job opportunities and weighing, Do I want to put more emphasis on my OTE? Do I want to put more emphasis here? These are things to think about as you're going through interviews for sure.
Yeah. And, just like coming back full circle to that, it's just so important that when you assess the trade off between a salary and equity position, it's just keep in mind the trade off that you are making in terms of risk, how much you are actually giving up for that potential appreciation. So, some of the things that I do advise people is like, it's great to have equity, but you have to prioritize your own personal needs in terms of your own expenses, what you need to get by, and making sure that your salary matches up to that as much as possible before you take on this equity, because you're trading a very safe salary for something that is even high risk to high net worth investors. It's massive between the 2. So important to see that, and important to see a vesting schedule like this, because once you get the equity, you're playing the long game once you get into that equation. So important to assess that in here.
Yeah.
Looking at some of the, oh yeah.
I was going to say, Max, do you remember? Okay, so there was a really recent situation. I won't call out who the author was, but on LinkedIn, I know that you saw this. I know that's why you're smiling. But there was a situation in which someone had worked for a unicorn. And so they had their options fully vest, and then they went to exercise those and got hit with a huge tax penalty and got into like a really bad financial state. Do you know this situation I'm referring to? And can you just I don't know if it's going to fall into the later part of this presentation, but that's one that I think a lot of us saw on social media. But I'd be curious just if you could kind of like take us through why that took place and how folks can be aware so that that doesn't happen to them.
Yeah, I didn't see the post, but I was told about the post by a couple of people, and I immediately knew what they were talking about. And I can fast forward to that section that has to do with stock options as it is. So, to understand what happened in that situation, we have to understand the role of stock options itself. So, I'm going to first start with the entire premise of a stock option, because the section that you're referring to is probably one of the most complicated tax sections that you'll ever come across in personal finance. So let's start with the basics here, right? So when we have stock options in general, there's a premise called exercising that I called before. And I have this little visual here to help us understand what that actually means. Again, exercising option means the right, but not the obligation to purchase stock, which means that when you are given that ability, you don't have to buy it. You don't have to receive it. It's up to you. But if you did want to buy it, it's important to know the terms. So in this example, let's say an employer said that this person gets 1,000 shares and they can exercise them at $1, which means that if they were to exercise all of them, they would have to pay $1,000 up front. By them simply paying the $1,000, that $1,000 doesn't get taxed. Now, let's say that at the time, the fair market value or the current valuation of the stock is at $5. If it's 1,000 shares at $5, that means the value of the stock option itself is $5,000. But because the exercise of this is $1, you only bought it for $1,000. So what you end up having is you bought something for $1,000. It's worth $5,000. You've already made a gain of $4,000 in between. This is the premise of stock options, is that you basically are able to buy the stock at a specified price, and in most situations, lower than what it's currently valued right now. Now, this premise of exercising options comes with pros and cons with it, and we should dive into those. There are two different types of stock options you're going to come across. The most common one are NSOs, or non-qualified stock options. So these are the basic stock options that you would get, and it's important to understand how this works in the world of taxation. So I put this visual on the right side showing the strike price, the fair market value, and the potential sale price. So in this example, the strike price of this option is $10 in it. You buy for $10, the $10 is not taxed. Now, let's say when you had bought the stock option itself, it was valued at $30 per share. When you exercise the stock itself, the difference between the $30 and the $10, which is that $20 in blue that you see at the right, that is going to be immediately taxed as income. So when you exercise it, that difference and that gain is going to show up as income on your W 2. This unfortunately comes with a negative consequence, being that if you don't sell your shares, you basically have this extra tax that you didn't sell shares for. So you have to come up with cash somewhere, whether it's out of your own pocket or selling these. But on the flip side, once you do that, any appreciation after that is treated as a capital gain. And remember, those capital gains are preferential because they have lower rates than your income. As long as you hold the stock for more than a year after exercising it and 2 years after the grant date, it will be treated as capital gains. If one of those are not fulfilled, it's going to be disqualified and it's going to be treated as ordinary income. But it's important to see how this is structured, because when you exercise non-qualified stock options, you're going to get hit with a tax consequence immediately. Now, some people would say, well, why would I even want to do that? Well, the sooner that you do it, the more of the appreciation of your stock options will be treated in that capital gain. So it's important to assess if it makes sense to do it early based on your own financial situation, your assessment of the company that you work at, and how long you intend on being with the company for. Now, this is the most common stock option. The next stock option is going to come back to the question that you had about your situation, which is incentive stock options. Now, this has a little bit better tax treatment than NSOs, but it is much more complex. So why that happened to that person that you were mentioning that came up with an unexpected tax bill? Well, to understand that, we have to understand the structure of an ISO. So when we had an NSO before, that difference between the $30 and the $10, when we exercised that, we realized immediate income. That was going to show up on our W-2 as income. When you exercise in an ISO, however, that does not happen. There is no taxable event that occurs. So when you do that, what ends up happening is nothing comes up on your W-2. So it's like, okay, awesome. I get to exercise, no tax treatment immediately. However, and it is a big however that goes back to the situation that you described, it does get calculated in a concept called alternative minimum tax, or AMT is what we like to call it. What AMT is, and again, like I mentioned, it's probably the most complicated tax subject you will encounter in personal finance. And I don't need to go into details on how it's calculated, but the entire premise of AMT is the government says, if you make a lot of income or if you have a lot of tax deferred benefits and whatnot, we want to make sure that you pay a minimum amount in taxes. That's going to include deductions that are made, your income. And of one of the few things that are added into this is the ISO. So instead of you realizing the $20 immediately, that $20 gets added to AMT. And what usually happens is if that difference is large enough, it's going to get added to AMT, and then you're going to end up coming back with a massive tax bill in the end. Carta has a calculator to help you see if you can, like based on what your income is, if you're single, married, and what your strike price, fair market, if you input all those details, it will give you a basic calculation as far as that's concerned. But what usually happens, and what I suspect happened in this person's situation, is they delayed the exercise for a very long time. And the difference was so massive that even though the person had a huge gain that they could have, it ended up creating a tax bill behind it. I have seen situations where they have $1 million gain and then they exercise it and then they come back with an AMT that's around $250,000 or $300,000 more than they would ever pay in taxes. And there are ways to avoid that. You can be strategic with it by exercising early, not exercising all of them at once. There's a lot of methods to go about it. But I will say, in order to be in that situation, it would probably be blindly exercising all of them without running the numbers first. So if this sounds complicated, trust me, it is complicated. Like
Yes.
there is no simple way to understand AMT. All you need to know is that when you exercise ISOs, there's a separate tax bracket that gets involved in it. And it's important to, when you do this, to do this with a financial professional or a tax professional, because you need to know the numbers, you need to know how it affects you. And then we're not even including everything else in your financial situation. So it's a bit of oversight on ISOs. That's why I put it as an illustration like this, because it's just so complicated to look at on paper, especially when you're just looking at numbers and whatnot. So I hope this was a little bit helpful in terms of understanding that component.
Yes, absolutely. I think one of the big things, I honestly feel I waited too long to do this, but getting a CPA and like having a financial resource mine's like a hybrid kind of CPA advisor, is incredibly impactful. I mean, to be able to have resources where you can ask these questions to, I'm pretty sure you can work with Max if you so choose. So that's someone you can hit up. But it's really like it is really, really incredibly valuable to have someone that you can kind of like answer and go through scenarios and talk through things. And also, like, we're talking about potential home purchases for 2024, 2025. Like, we're having those conversations super early and figuring out where things need to fall. So it is really critical. And that's something I waited a really long time for, because to be honest, until I had a company, I didn't feel like there was a reason to have a CPA or a financial advisor, really. And so I think that's something that we're seeing more. Like, folks are starting to, even if it's just them working for other companies, they're starting to look into financial resources. They're starting to kind of arm themselves with this information, because many of us have hit kind of road bumps and different things along the way that we just weren't aware of, because to your point, Max, we were never taught this. I have a question here from the audience. We would love more questions too. So I feel like, Max, you are like keeping us all enamored with the pictures and with everything you're going through. So this is like a very like focused session. But if folks have questions, keep submitting those. But I know we're all like deep in the weeds listening to you. So Meredith asks, and actually let me just pop this right on the stage. Meredith asks, I'm considering coming on as an advisor for a friend's company in exchange for equity. Good. Ooh, I like this. I do this too. Assuming sky's the limit, how do I figure out how much to ask for? What kind of questions should I be asking before jumping in? Thanks.
Yeah, I think that some of the questions that you should be asking is really some of the areas that we were looking at, which is are you receiving restricted stock, stock options? What types of stock options? Are they NSOs? Are they ISOs? Understanding the strike price, understanding the vesting schedule, also a huge one in there, because I've seen some companies vary in terms of how they actually issue that. And, in terms of asking for just simply equity, I think it's also just assessing, just how much equity do you need personally in order to actually be invested in terms of your time, value that you're added, because that's really an assessment over, the value that you're bringing to the company with how much you are providing as a reinvestment. But the thing that I would figure out is definitely the type, the terms and conditions, the vesting schedule, the current valuation of the company, and understanding, from their philosophy where they think the company is going, because you'll need to include as much information as possible to understand if it's a calculated decision for you. So I hope that answers your question. But I think really assessing the structure of the actual equity itself is incredibly important.
Yes. And Meredith added its pre-seed fundraising this fall.
Okay, yeah. Well, if it is pre-seed, you're probably going to have access to some restricted stock as it is. One of them, known as an RSA, is usually known in earlier stages. If they give that stock to you outright, most likely they'll also probably give ISOs over NSOs in the beginning. So I think it's important to see what that actually looks like, and the terms and conditions. But also just keep in mind, when you are that early, I think it's very important to note that the earlier that you are, the less liquid these equity options, restricted stock are. So you have to be under the preparation that you're going to be holding on to these for a very long time. And there may not be a secondary private market for you to sell to. So you have to come into it with that expectation.
Yeah, 100%. There's a follow-up question, but before we even go in there, one thing, I'm not sure if people are aware of this. I do advising for several companies right now. I'm adding a few to my own personal portfolio. I kind of frame my advisor opportunities like I would a job opportunity. Like I kind of hedge my bets a little bit. So while I definitely want equity and I have equity from the companies that I'm working with, I also look for things like a stipend. Some of those are quarterly, some are annual. Some we do like trade agreements with. There are other ways that you can also financially benefit from these arrangements, especially if you're going to be an advisor that's like heavily involved with, for me, I'll actually go through, I meet with their product team, I early demo things. I'm talking to every single part of their organization. I'm helping with messaging before things go to market. For me, sometimes I frankly don't feel comfortable just accepting equity and I want to have some cash in my pocket. And so I'll actually kind of cross pollinate and say, I'm really excited about this opportunity. I'd like to come on as an advisor. By the way, I'm looking for a stipend plus equity. And is that something that can be arranged? I have yet to get a no in that case, to be honest. And in some cases, they've actually left the equity where it was at and just added cash on top of it. So again, like just keeping in the back of your mind, negotiating is something that you can do even if it's not during the job search. Like there are ways to kind of change and morph things into what makes sense for your own financial situation. And I think that's a point that you've emphasized a lot, Max, is like keeping in mind what your particular financial situation is and preparing for what your particular costs are going to be. Because we have folks in our community that are our parents. We have folks that are doing continued education. Like these are all considerations that you have to make and have to think about as you're navigating different opportunities. The follow-up question came from Tessa Young, which kind of follows along with what we were just talking about, which is piggybacking off of Meredith's question. In consulting and or advising for a cash-strapped startup that offers equity, what is the best type to ask for? So you kind of covered this, but is there anything else you would add in terms of what you would potentially ask for if you're in this seat, Max?
Yeah, I mean, typically, if you're in those early stages, I mean, a lot of them are very good as it is. But, if you're talking about which one would you prefer, usually ISOs are the way to go just because it's not a financial commitment up front. And just the fact that when you do exercise it, you don't have to immediately realize income taxes upon that exercise, I think is incredibly important, especially when you don't have too much cash on hand and you could be able to exercise those over time. Um, I think you could even say RSAs would be good simply because capital, when it vests, it's typically available within private equity, but they only give that to key employees I've usually seen. So I think ISOs are usually the way to go. That being said, I think any of these options are restricted stock. It's going to be very good for you. It's just the manner in which how much you can get, the strike price in which you can actually do it, the terms and conditions. I think those things are very important. But if I've seen anything from a lot of equity employees, they're all just like, I wish I had more ISOs to exercise.
Mm-hmm. Max, there's a question that's come up a few different times behind the scenes that I think would be valuable to cover here too, that I think you can speak to. So one misconception that happens often with folks that are in like the individual contributor side of the house. Because to your point, usually the packages that folks VP level and beyond are getting are going to look a lot different than what like an AE or an SDR is looking at. What can you say about volume? Because I've had a couple of people that I mentor where they're like, I'm rich, like I'm getting 1,000, or I'm getting like 10,000. Like these are numbers that sound really, really cool on paper often. Can you talk a little bit about like volume and how that plays into all of this? Because I do think this is something that's a big misconception, that it sounds really good and you just don't know what you don't know.
So when you say volume, are you talking about like the amount of shares currently
Yes.
available?
Yes.
Yeah.
Apology. Yes. Cheers.
Yeah. So the thing about it is the amount that you could get really hinges on the actual value of the shares itself, because you could have 10,000 shares of a $1 stock, and that would be more valuable than 100,000 of shares that are worth a penny itself. I hope I'm doing the math straight off the head that way. But the fact of the matter is that I don't necessarily think that the amount of shares necessarily matters. It just matters on where the stock price is relative to where the fair market value is, or where it could potentially go from there. It's all math at the end of the day. So it really hinges on what that is. So a lot of people like to get more shares, and that can be great, but it ultimately hinges on the growth of the actual company itself. So more is obviously better, but I wouldn't say that more necessarily means it translates to more in terms of the overall value of the actual stock. That comes down to the price itself and the growth.
Mhm, mhm. One other question that's come up, and please keep submitting your Q&A. We'll keep we'll pump back to you, Max, so you can
Yeah.
take us back. But as far as folks who are kind of like negotiating and going through these opportunities, what are your recommendations in terms, like, I think for salespeople in particular, one thing that's scary is like, okay, I got my offer, and options are a part of that, but we get really focused on OTE, and it's like, I just want my OTE to be squared away. And so you're kind of like having to negotiate, hopefully, already there. And then to add like another thing seems like a little intimidating, because it's like, am I now high maintenance? I'm asking for like salary, my commission, and now like option, and it's just like starting to like add all these things to the table. What recommendations do you have in terms of like when folks are negotiating? Like, do you recommend they have kind of like a third party resource that kind of take them through this? Do you recommend like doing it in stages, or do you recommend like I get an offer letter and I'm like, okay, here's my counter and I have all three things kind of like outlined? Just anything on like the negotiation piece, because I do feel like this is where this conversation can sometimes get lost for people.
Sure. So when I work with sales professionals and they're adjusting to a new company, we go over the entire contract with them, what they're being offered, the benefits, and we have to assess based on their own financial situation if it aligns with where their current expenses are, not just their essential expenses, but their discretionary expenses. Like, is it just going to be tied to what's going to make sure the lights are on, or just their entire lifestyle? And then on top of that, how that amount that they would be receiving allows them to continue saving or continues to invest on the side. And we have to break down each of these tiers, whether it's their salary, their commissions, their bonuses. And then if we add equity on top of that, really assessing, okay, if we have all of these structures in here, what is the amount of salary that I need to maintain my ongoing expenses? How much of that could be used for my discretionary piece, for bonuses and commissions as it is? How much of this will be going towards some of my other buckets that I have, whether it's, I need to fulfill my emergency fund, if I need to purchase a home, if I need to go on vacation, as you probably will deserve. The equity side of things. How long do you intend on keeping it for some of your long-term goals that you have? We have to break each of these down and give them a purpose before just blindly accepting the terms and conditions on it, because it has to align with your situation so it doesn't feel like you're in a trap. And when you make that adjustment, it is aligned with it. So depending on what we come up with allows us to determine what we could counter offer to the employer, because for a lot of my clients, The best counter offers that they have is just simply, this is not enough to fulfill my expenses based on what I put together. If you can meet me right here, I'll be glad to sign the contract. So if we can back that up with the financials that were put together, I mean, I think that makes you look good to your employer that you're doing your due diligence. So important to break it down as far as what these income structures look like, how they can fulfill your expenses and your long-term saving strategy. And if there's any, difference that we need to supplement, how we can use that to counter offer and get the contract that you deserve.
Yes. And this is our semi regular reminder that you should always be negotiating. Companies are expecting you to negotiate. If anything, to Max's point, it often elevates how they view you because they see you as a salesperson that's going to be really strategic and go back and be able to make changes and kind of come back to the table. So that's actually something that's viewed typically in a very positive light and is already budgeted and forecasted for before you even kind of came into the job interview process. So negotiate, please negotiate always. That's my little PSA. I feel like I throw it in on every event somehow to make sure we're all negotiating. Max, what else do you think is really critical that we should cover in our last 10 minutes or so? And we'll leave some space if others have questions, but what else do you think is really critical for folks to walk away with from today's conversation?
Yeah, and I think it'd be worth noting one of the other sections in here that I kind of skipped over, but like these two sections that we looked over was looking over the stock options. I wanted to quickly look over what the restricted stock actually looks like and what those entail. And I'm like trying to get it to there we go.
Yes, and Leah dropped a really good comment, especially as women, we don't often ask for what we deserve and we leave so much on the table. So yes, could not agree more. The data also agrees, sadly. So we
Yeah.
must do better.
Yeah, and I think it's important to know the restricted stock section over here. So there's two different types that you'll commonly see. The first one are restricted stock units. And remember, restricted stock is what's given to you without a financial commitment. You're going to commonly see restricted stock units mostly with public companies. There may be cases with private, but you'll see with public. And when you are given the RSUs in general, they are going to be taxed immediately upon you receiving. So let's say if you look at the right, they gave you the RSUs at $85. When you get that RSU, that's going to be taxed immediately as W-2 income. But any appreciation that comes from that thereafter is subject to capital gains treatment. Why this is important to know this concept is because there wasn't an actual commitment behind it. Some people get hesitant about restricted stock units saying, well, I either want to keep this long term or I might not want to keep it long term. And sometimes I say, well, you don't have to keep it long term. You could just sell this immediately if you needed to. They'd be like, aren't I supposed to keep this long term? If you need it. Restricted stock units, remember, is a form of compensation that you are already taxed for. So you could sell this off immediately if you need the liquidity for your emergency fund needs, paying down debt, purchasing a home, whatever that you need it for, or you could keep it long term. But the main difference between this and the stock options is that the company gives this to you. Now, one of the most common questions that I get is, Max, if I'm going to be taxed at $85, does that mean I'm going to come up with a tax bill towards tax season? Like, am I going to have to pay this out of pocket? Probably not, just because of the fact your employer is usually doing it on your behalf. What they will usually do is, if some of these are vested immediately, what your employer would do is they will take some of the shares and they will sell them. So, for example, let's say that you get 250 shares vested to you. Some of that amount is going to be taxed at the total amount that is given to you. What your employer might do is, if they say, well, you're going to be taxed at 20%, they'll say, we'll sell 20% of your shares and we will use that amount as withholding for your taxes. So if you get 250 shares vested, your employer will say, all right, we're going to keep 50 of those shares, sell them, and withhold it for your taxes. You get 200. What this allows you to do is not go to your tax preparer and be like, oh, I have an unexpected tax bill. it will usually be done on your behalf. So I think it's very important to understand this one. The other type was an RSA, and I did mention this a couple of times. They're very similar to RSUs, but mostly available in private companies. There are some differences between the two, but the important aspect to know about restricted stock compared to stock options is just simply the fact that you don't necessarily have to pay anything out of pocket. They just give this to you. It's part of your compensation. So it's nice from the sense that you don't actually have to give the company anything to actually purchase it. So wanted to go over that section very quickly as I was going with stock options. Like I said, there's other equity to go over, but I would say those ones in particular are the most common ones that you're going to see, especially in pre-IPO companies.
Amazing. Any last questions? We're going to do a last call for questions. Now or never. Just kidding. Max kind of hangs out with us like once a quarter. So now or like three to 4 months from now. But let us know if you have any last questions. Max, in the meantime, where can folks find you? What kind of services do you provide? Can you just tell us a little bit about that so we know how to reach you?
Yeah, absolutely. You'll find me mostly on LinkedIn, like we've already connected before. I'm also on Twitter, or you can find me on my website, pashmanfinancial.com. I mostly help with sales professionals because not only are they amongst my network, but also the fact that they come to me with a lot of concerns about their cash flow, usually fluctuates with some fixed income and some variable forms of income, especially when it comes to equity. And my goal is really to give you clarity on your situation, help you visually understand it in a simple way as much as possible. The way that I operate too is that I'm constantly engaging with people and helping them maximize their knowledge as well. So I am always available for any questions in my DMs. You don't have to schedule a call, charge by the hour. I want to make sure that you are readily available to make these decisions. And then if you want your specific situation fulfilled, I'm obviously available to take on additional clients. But in the meantime, I want to make sure that I can be a resource as much as possible. So you can shoot me a DM on LinkedIn or on Twitter if you're on there, or however way you would like. And I'm happy to answer any questions because I believe that everyone should be able to have access to financial education that's at their disposal.
That's amazing, Max. Yes. And I can personally attest, we went through some questions of my own, and you were an incredible resource. And I just am very thankful for the advice that you've offered me as well personally. But yeah, your content, I definitely recommend folks follow you on LinkedIn. You have this very digestible way of providing content that doesn't make me feel ashamed ever if it's a topic that I don't understand. I love your pictures. Whoever does your graphic design is awesome. I don't know if that's you, but
That's me.
is it? Oh, that's
Yeah.
awesome. All right. We need you for Women in Sales. No. But yeah, so yeah, definitely recommend checking out your content because I just feel like you cover a lot of really important topics, anything in the financial spectrum. So sometimes you talk about commissions, sometimes you're talking about taxes, sometimes you're talking about stock options, but I love that you cover this wide array and this big gamut of topics, and you do so in a way that's very much not ego driven and doesn't feel shamey if you don't understand it. So thank you for being an incredible resource, not only to the women in sales community, to the greater sales community at large. So thank you all for being here today. Make sure to connect with Max Pashman on Twitter and LinkedIn. And if you're not following Women in Sales, make sure to follow along with us on LinkedIn as well and get into our Slack community where Max is also in there too. And we will be posting even more events coming up. They're going to be on all different types of content and topics. So we look forward to seeing you all again soon. Thank you very much.